Hello, and welcome to the Gryphon Financial Partners and GBQ webinar on the 2025 tax law OBBBA explained. So today we're going to go through some of the major changes in the new tax provision and how it affects individuals and business owners. So today we have two great speakers. We have Michael Solik. Michael Solik is the head of investment solutions for Gryphon Financial Partners. Through that role, he helps people with investment management, estate planning, and tax planning, along with succession. We also, from GBQ, we have Scott Eichar. He has a long background, an extensive background in public accounting. He's also a partner in the tax and business advisory services at GBQ. I'm Mark Fleming, so I am a senior investment director here at Gryphon Financial Partners, and I will be your host today. Here at Gryphon, our objective is always to help make people's lives better, and one of the plans that we're trying to do to continue with that mission today is to walk through these changes and how they might impact you and ways that you might benefit from these new changes. So. With that, we can get started and start digging in. So my first question, we're going to ask Scott here. What are some of the key changes of the OBBBA from the current tax regime that maybe just give an overview?
Yeah, thanks, Mark. Welcome, everyone. Great to be with you over the lunch hour. It's sunny and blue skies here in Columbus, Ohio, so hope it's nice where you're at. As Mark said, so we're here to kind of cover the OBBBA, the One Big Beautiful Bill Act. This passed on July 4th and was kind of a sweeping tax legislation. It was really the marquee legislation of President Trump's second term. And really, when we think about this bill, there's a couple things. One, this was really aimed at extending and making permanent a lot of the provisions of the Tax Cuts and Jobs Act. If you remember, in 2017, President Trump's first term, his major piece of legislation was the Tax Cuts and Jobs Act. Many of those tax provisions that we've grown to know, like, dislike some, were running up into some sunsets where they would have reverted back to old laws at the end of 25. And so the One Big Beautiful Bill Act was under a lot of timing pressure to get passed in 25 and make some of these things permanent and also provide some fixes to some of the provisions that weren't as taxpayer friendly that we'll also dive into. So, overall, a lot of the individual tax provisions were a carryover TCJ. There's not a lot of brand new concepts, but they definitely made some tweaks along the way as well. And we'll talk about some of the things that are changing. And more so, what does that mean for you? What does that mean for a business owner, a high net worth individual client, individual clients? That's what we're really trying to do. So you have some action items heading into year end and the changes that start in 25 and also moving forward. So, really the aim was, like Congress always tries to do, make things a little simpler. We're not sure that they fully accomplished that because the bill is a few thousand pages long and there's a lot of complexity with some of these areas and a lot more guidance needed, which we'll point out as well when we can. But like I said, I think a lot of what they attempted to accomplish was making some of these TCJ provisions permanent. So we can dive into those if you want to go to the next slide, Mark.
Yeah, definitely. So that's a great intro, and thank you. So what are some of the items that were made permanent versus what remains temporary?
Yeah, I think the biggest one here, talk about tax rates. So the top tax rate remains at 37%. OBBBA, OBBA, we'll just call it for short, did not raise the overall individual tax rate. It did not make changes to the corporate tax rate or the lower brackets. You'll see there was a little bit of tweak in the 10 and 12% brackets. It's a little more favorable, if anything. But really, it was about making the current tax rates permanent. If this would have not have passed, we would be sunsetting or reverting back to the top rate of 39.6. So that was in effect pre-17. So this was welcome news that the tax rates are basically staying the same.
And so a lot of taxpayers are just going to use the standard deduction. So what's changed there, and who's really going to benefit?
Yeah, thanks, Mark. Yeah, this is where there's probably the most planning involved, and it's been around in some form really because we, like Mark said, we have these increased standard deductions. You'll see here for 2025, those remain in place. So for a married filing joint couple, you're either going to take the itemized deductions or standard deduction. You can't take both. So you'll see that in order to itemize, you would want to have more than 31,500 as a married couple, or else you're better off just taking the standard deduction. Um, you know, the big areas we see that impact this, and we'll get into more in detail, would be charitable contributions and state and local taxes, which there were some changes on. But overall, many clients take the standard deduction several years, in a row, or maybe there's a year where you can itemize and then take the standard deduction the next couple of years. So we'll talk about some of those strategies. It also eliminated the personal exemptions. You may remember those from pre-17, for each household member of the family, taxpayer, spouse, and kids, there was these personal exemptions. Those were eliminated, which does give us a little bit of simplicity that we're only looking at just the standard deduction. Next slide.
It's great. And yeah, some of the quite a few other small tweaks here that go over.
Yeah, so they did eliminate personal exemptions. We do have this new concept of a deduction for seniors. So for a taxpayer and spouse that are over 65, you could have a maximum 12,000 on a joint return. But you'll see that applies to 25. That starts in 25 and goes through 28. There is a phase out for income. So to the extent you're over that 150,000 of income, that benefit will go down. But for a lot of older retirees that may just be withdrawing on retirement plans or savings and Social Security, there might be some planning here to make sure that you can take advantage of this potentially $12,000 deduction. So it's definitely, when you add that to the standard deduction, I mean, you could quickly see how you could have a decent amount of income and not be paying really any tax as a senior. So some good benefit there. A couple other provisions, no tax on car loan interest. As we talk about the themes of the bill, one of them was, making the TCJA permanent. I think another theme, and maybe something that's probably evolved a lot even since President Trump's first term, was Made in America, America investment, America first. Really trying to reward manufacturers who are moving manufacturing back to the U.S., providing incentives to do that, both for individuals and for companies. And this is one of those items that there are some requirements that has to be met. You'll see it has to be a U.S. assembled vehicle. There's some limits on the size of the vehicle as far as the purchase price, but there are some phase outs, but something to be aware of there, that deduction on car loan interest.
That's great. And then what about the child tax credits?
Yeah, so these are here to stay. These were made permanent. You'll see there was a little bit of increase to 2,200. It's currently at 2,000. So a little bit of increase there. But the higher phase out thresholds were made permanent. So, taxpayers can have upwards of 400,000 in income before they start to phase out of these credits. So, it can easily be, obviously for a family with 3 or 4 kids. I have 4 of my own. So, you could easily have 6,000, 8,000 of these credits on your return. And then the $500 credit for other dependents would be like if you have an older parent living with you, or a child with a disability, adult child, or some kind of other dependent living with you. So yeah, some permanency there as well. Moving on.
And the famous no tax on
Yes.
tips and overtime that's gotten a lot of attention.
Yeah, so this was really, and this really had a lot of bipartisan support throughout the campaign. If you remember, both President Trump and Vice President Harris actually were pretty both supportive of no tax on tips, no tax on overtime. So they had to deliver on that. Um, Devil's in the details a little bit on this. So this is an individual deduction. You're still subject to FICA, Social Security, Medicare taxes. The employer is still subject to their side of the employment taxes. But there is this deduction now for individuals that qualify. There's also some income phase outs of around 150,000 where you could exclude and deduct 25,000 of income on your return for tips, or up to 12,500 per individual for overtime. We're at GBQ, we've gotten a lot of questions on these provisions, mostly from a lot of businesses and that are having to comply with these new reporting standards. We've put a lot of guidance out on our website and will continue to, but the IRS is expected to publish some transition guidance for 25, because they're not going to amend the W-2s that will come out in January. So if you're a business and have employees that earn overtime or have tips, I mean, you should definitely be talking with your payroll provider and accounting firm about how you can prepare for these informational disclosures to make sure your employees have what they need to claim these deductions on their return, because it's a great benefit that you can offer to your employees. So there's some temporary guidance that's being put out, and then going forward, we expect the W-2s to be amended and changed, and there to be some more official ways of tracking and reporting this. So there's a little bit more flexibility for
That could be
25.
tricky, right? Because it's just on the half portion of the time and a half.
That's right. That's right. Yeah. So if you're kind of paid time and a half, it's just that half portion that's actually overtime. So you got to get in the weeds of kind of your payroll system and information, and then figure out what can you provide to your employees that'll give them what they need.
Yeah, it sounds like that'll be a fun puzzle to dissect at the end of the.
Yeah, yeah, and anytime you're dealing with new legislation like this, it takes time for those regulations to come out. In fact, the Congress and alongside the IRS just published a list of professions that regularly receive tips in their customary trade of business. So, as a business, you can't all of a sudden start accepting tips, or a law firm can't have like a tip jar and get paid that way instead of billing their clients. So there's going to be a lot of guidance coming out of like even what industries and businesses are eligible, and then getting all the reporting set up and to employees is always a heavy lift for the IRS and Treasury.
So are you supposed to tip your tax accountant?
Yes, you can. I always accept tips. Golf tips.
And then what about the mortgage interest?
Yeah, we can just hit on a couple of these things quick. I think, mortgage interest, no change there as far as that $750,000 home indebtedness limit is still in effect. So to the extent, mortgage interest is still deductible up to that 750,000 of debt. If you have more than that, then your interest deduction is going to be limited a little bit. That's one of those itemized deductions. And then miscellaneous itemized deductions, it permanently terminated those. Again, it's one of those concepts that's not been around now for 7 years, but had OBBBA not passed, miscellaneous itemized deductions would have been coming back into play. So this permanently eliminated those. Things like safe deposit box fees, investment management fees, tax preparation fees. There's a few other deductions as well for employees that are eliminated to kind of help simplify your itemized deductions.
And the state and local tax
Yeah.
exemptions. I know that's probably hit a lot of people on the call. So I think
Yeah, this is a hot topic.
updates there.
Yeah, this is definitely a hot topic. I think, there were a lot of the math of getting the votes on this bill really required a lot of negotiation in this area. If you think about, you have a lot of House Democrats and House Republicans in high taxing states, high taxing property states. You think about New Jersey, California, New York, but even states like Ohio that have significant property taxes that fund our schools here locally. We have city taxes, state, and local taxes. So that $10,000 limit for a married filing joint client really precluded a lot of clients from fully deducting their state and local taxes. You'll see we get some big relief here where it's increased to 40,000 and it's even adjusted for inflation. So it'll continue to go up. There is a little bit of a timing window on this where in 2030 it'll go back to 10,000. So this isn't permanent, something that future Congress will have to deal with. And then you'll see the income phase out. So if your income, your modified adjusted gross income, basically your total income is greater than 500,000, you would start to have a 1% phase out down to that 10,000. So don't make me do the math on the call, but basically once you would quickly, if you make $1 million, you're probably going to be completely phased out of this, in other words. So not going to benefit everyone, but certainly a lot of clients that can be under that 500,000 income out there and be able to deduct property taxes, local taxes, income taxes. One thing to know on that, this is where maybe there's some timing and planning you could do. For example, if I was going to be in a higher tax bracket next year and be phased out a lot of these taxes, I may want to prepay my property taxes in December. I may want to make sure I have 40,000 of local taxes. And if you're not paying a lot of Ohio tax or you don't live in a taxing city, it may be only property taxes where you have some flexibility there to prepay those before the year. And so something to kind of consider because this is retroactive to 25. So
That's
planning
great.
there. And if you were able to deduct 40, that's where, when you think back to that standard deduction we talked about at 31.5, if you can maximize the state and local deduction, you're itemizing just with this alone now. So that's a nice benefit to clients. You don't have to have mortgage interest or charitable contributions. You may have those on top of this, but this would get you over the standard alone now.
Yeah, and that's nice with some of these things being retroactive to 2025. I mean, that's from a economic perspective. I think we're expecting the first quarter to have the largest tax refunds that we've ever experienced within the U.S. economy. So, very big stimulus heading into the first part of the year next year.
Yeah. So I think there was some talk about whether or not some of the withholding rates and for employees and things were going to be adjusted for some of this. And I think the approach there, right or wrong, politically is kind of like, hey, let's let individuals out there get larger refunds. We may or may not be heading into a midterm year next year. So there's a little bit of inside baseball that always, Congress likes to play. But I think, I think you will see some kind of unexpected benefit here in this fourth quarter that, we weren't counting on because, we didn't even have this law pass until July. And there were times where it even looked like it wasn't going to pass. So, yeah, absolutely.
And we have quite a few other things that impact individuals, businesses. Maybe touch on the energy credits.
Sure, yeah, the energy credits. So these were things like the home energy efficient credits for new windows, doors, that are smaller, had individual limits on them, sometimes 600 with an overall limit of like 1,200. But there was also some larger credits in here, solar panels, and we've seen an increase obviously in the solar space, even in Ohio. You probably have some neighbors with solar panels on their roof. Those credits also are part of this, and all of those energy efficient credits, home energy efficient credits, end at the end of the year. There was also a credit for like electric vehicle plug-in vehicles that ended on 9/30. And then the only credit that's around it's smaller is the electric vehicle charger. If you put in like a charging port in your house, you do have until July 1 of 26 to do that. But most of these were eliminated in favor of some of the other items we'll talk about around capital investments and bonus depreciation, some other things to spur manufacturing and get away from purely incentivizing some of these green energy initiatives. So something else to be aware of.
And then you'll talk a little bit about the dreaded alternative minimum tax that can impact a lot of at least our clients with both GBQ and Gryphon.
Yeah, I think, the AMT is still a concept that can come into play for certain clients. It's basically, it- basically, there's a minimum tax. The extent a lot of your income is just capital gains or low, favorably taxed items. There are items you have to add back for AMT that could cause you to be subject to this higher, 28% AMT rate, and kind of drive up your tax rate. Um, this rule, without getting too into the weeds, is kind of a mixed bag. Some of what this did was make some of these favorable phase outs permanent. However, the way it phases out is less favorable, so it's a little bit of a give and take overall. Clients that were subject to AMT might just be subject to AMT slightly more or fall into it slightly quicker, but overall kind of the same regime as the TCJ. State and local taxes are an adjustment for AMT. So when we talk about the increased 40,000, one thing clients and individuals should do is make sure that, hey, if I'm thinking about prepaying my real estate taxes, is that just adjusting AMT and not giving me any benefit? If so, no need to do that. So there are situations where, because of AMT, some of these planning items don't apply. And so that's where every situation is different, and you want to run those projections and kind of look at the math.
That's great. And what are some of the limitations on the itemized deduction side?
Yeah, so as we kind of get into planning around itemized deductions and charitable contributions, a few things to be aware of. So you'll see that this bill eliminated the P's limitation. That was a limitation on overall itemized deductions. That's a little misleading because while they eliminated that limitation, they created a new limitation that basically did the same thing. They just aren't calling it the P's limitation. So this basically reduces your itemized deductions by 2/37. You kind of work out the math of that. What it effectively does is make your itemized deductions worth 35% instead of 37. So you can't fully, if I have 100,000 income and then I had 100,000 of itemized, I'm not going to quite be able to eliminate that income using these because there's going to be a haircut on those itemized deductions. Um, and there is a formula to look at the amount that exceeds the start of the 37% bracket, but basically high income taxpayers that are in the top brackets are going to see a haircut of their itemized deductions here. And that leads in, I think, some of the discussion on charitable contributions as well. We'll get
Yeah,
into.
before we hop into charity,
Yeah.
of course, what's not included in the bill can be just
Yeah.
as important as what is.
Yeah.
So what are the things that were notably left out?
Yeah, this bill took a lot of twists and turns. There were a lot of early House drafts. If you remember back to July, the Senate narrowly passed this, and the Vice President J.D. Vance was the tying vote. So it did have wider margins in the House, but there was a lot of moving parts to get everyone on board, get the votes you need. Um, you know, kind of talked about earlier, but no changes to individual income tax rates. That there was no changes to capital gain rates or qualified dividend rates that are taxed favorably. Cap gain rates remain at the 0, 15, 20 that you'll see here. There were proposed changes to excess business losses that would have been very unfavorable for a lot of business owners. And not to get too into details on that, but if you're a business owner and have business losses coming through from pass-through entities or rental properties or businesses, and those exceed for joint filers 600,000, those losses are limited to 600,000. The excess amount carries forward as an NOL. There were some proposals to not have that convert to NOL and basically stay as business losses until you generate business income, which would have made it a lot harder that next year to use up those losses. Whereas now we can use them against other income as a normal net operating loss. So a little bit of background there. We talked about the $40,000 state and local tax limit. SALT is what we call it. I said SALT the other day to my wife about this, and she's like, "What are you talking about? SALT, state and local taxes." So we love abbreviations in the tax world, but you know, basically there's a way for businesses to work around this where, if you have a large partnership or S corporation that has owners who are subject to state taxes, in most of the 50 states, there is a pass-through entity tax regime where the business can pay those taxes, deducted at the business level, and then pass through those credits to the individuals. That's a huge benefit because even with the $40,000 cap, a lot of times the state taxes could greatly exceed that, especially in higher taxing states. So this was a workaround to that $10,000 cap. There were proposals that to eliminate that loophole and to close this off to business owners. That didn't make it in the final bill. So all that to say, if you're taking advantage of pass-through entity taxes, it probably still makes sense to do so. Even with the increased cap, there's ways to work around that. So that concept's kind of here to stay. And then, QBI deduction, this 20% qualified business income deduction. Again, there was some proposals to maybe eliminate or carve out certain industries that were allowed to take advantage of this. But that was actually the 20% QBI deduction was made permanent. So if you have a pass-through entity, a partnership, S corp, you're generating 100,000 on a K1 to in generally speaking, you can deduct 20% of that income as a deduction. So you're only paying tax on 80,000, which really helps kind of your overall tax rate. So that was made permanent. Good news there for flow through businesses. And then the AGI limitation on cash gifts stayed the same at that higher 60%, that came into effect back in the CARES Act of 18. So yeah, overall, there, I guess, a lot of the individual highlights of this bill were what didn't make it into the bill, and that we didn't see major tax reform, because again, we're dealing with President Trump's second term and him wanting to keep some of the status quo of TCJA.
That's great. And you hinted at our next topic and the charitable deductions, and a lot of changes there, and I think probably an area where there could be a lot of confusion.
Yeah.
So definitely an interesting area to learn about.
Yeah, no, you're right. I think this is where probably for the most taxpayers have the most amount of planning to just look at these, whether you're on this webinar and you're a high net worth tax client, or you're a client of Gryphon, or a business owner, or you're just an individual who has a very normal tax situation, nothing complicated. Either way, really everyone should be kind of looking at these rules because obviously there's a lot of good charities that the folks give to, and you want to take advantage of the timing of these rules and kind of how you can get some of that tax benefit on these, because Congress incentivizes that through these deductions. But so there's kind of two buckets we'll cover first. First, if you're itemizing your deductions, so you're above that standard deduction we talked about, there's a new charitable limit there, you'll see for itemizers, of a new floor of 0.5%. So basically what that means is you have to take 0.5% of your income, and charitable contributions aren't deductible until they exceed that. So if I make $1 million, I take 0.5% of that, and it's 5,000. I think if I'm doing that math right, you don't get any benefit on those charitable contributions until they're over 5,000. So a little bit of another floor. And then for non-itemizers, this is a benefit. If you want to go back one slide, sorry. All right, fine. For non-itemizers, so if you're taking that standard deduction, there's actually a way where you can still take up to a $2,000 deduction on a married filing joint return for cash charitable contribution. Not a huge dollar amount, but certainly good news for a lot of folks that really don't itemize, just due to the math of getting over that 31,000, where they can still give cash to organizations and take that contribution, and that starts after 25. So kind of be aware of the differences there, and the 0.5% floor starts after 25 as well. So for 25, for charitable contributions, we're kind of still in the old rules. We're not dealing with that 0.5% floor. or this new deduction. And we're also not dealing with the itemized haircut overall that we talked about, that 237's number. So I think if you want to flip to the next slide, I guess where we can, like, accountants love to say it depends, right? Every situation is a little different, but in general, I would say that charitable contributions are probably worth more in 25 than they will be in 26, because in 26 we have the limit on itemized deductions. We have this new 0.5% floor we got to get over. So if you're making large gifts or you have a large income in 25, probably if you can get that 37% benefit in 25, take advantage of doing that. Prepay charities or use a donor advised fund. I know, Michael, those are very popular with a lot of your clients and our clients. So to kind of take advantage of front loading as much charitable contributions as you can to get this maximum benefit. But they're still deductible going forward too. So it's not a all or nothing, just maybe worth slightly less going forward.
Yeah, and I'll just kind of add on to Scott's kind of main points that he was starting to hit there at the end. I mean, bottom line here is that there's going to be less benefit per dollar received going forward after 2025, right? So for families that actively give, or for families that are considering large gifts, completing those gifts in 2025 will maximize your benefit. Now, the challenge, of course, here is if you're planning to give, but maybe you're in a situation where you don't want all of that money going to the organization all at one time. Maybe you want to tranche it out over, 6-month windows or, several years, or maybe you haven't even decided which organizations you want to give to yet. You just know that you want to give. Donor advised funds are a great way to make the gift, to benefit from itemizing those deductions, getting the tax benefit, but you still have control over when you dole out that money to each organization.
Yeah, that's great. Thank you, Michael. You finally get Scott take a break here. Michael, obviously he's works with lots of clients and helping set up this timing, and
yeah, and they're not just for the wealthy, right? I mean, they're pretty low cost, easy to use, really friendly. I think individuals and families enjoy having this fund that they can kind of like, it's like having your own little foundation. It really is, where you say, hey, what organizations are we going to give this to this year? And it's very easy to send it from there. And like Michael said, really just controlling that timing is nice, especially let's say we have a transaction occurring, this year or next year, and you want to front load this. You may not have any, you might just have some philanthropic intent, but you don't know if you're giving your alma mater or the food bank or whatever, and just want to set it aside and get that charitable benefit, and then figure out, kind of where to distribute that later.
That's great. And so, Scott, so a lot of clients of both firms, both Gryphon and GBQ, are business owners themselves. So maybe we can hit some of the highlights of some of the changes that are going to affect business taxes.
Yeah, so really, the business side of this bill really stole a lot of the thunder. We kind of say there's kind of a big three here that we'll kind of hit on. We've put out, GBQ's put out a lot of content on all of these items. We actually did some webinars just specific to each of these topics. So I invite you to go to our website or reach out to me if you want more information on those topics, and we'll continue to put out more, because yeah, there was kind of three major changes here we'll talk about on the business side that really could be very meaningful to individuals as well, because many clients own pass-through businesses where, yes, these are deductions for the business, but ultimately that ultimate taxpayer is an individual. And so by getting the benefit at the corporate level or the business level, it's flowing through and impacting, the 1040. One concept you may be familiar with, 1202 stock or qualified small business stock exclusion. It's been a concept that's been around now for a while to incentivize investments in startups, and there's some requirements that have to be met. Typically you had to hold the stock 5 years to get the exclusion. The company couldn't be over $50 million in gross assets. There were some caps on that. There's certain industries that's carved out, accounting, law firms, investment firms, health, dental, medical practices, things like that. But there's a lot of industries where if you invested in stock and held it for 5 years, you could potentially exclude up to $10 million of gain. So you can imagine how powerful this is. The good news is that this bill expanded some of those benefits. So instead of having to hold it 5 years, you'll see there's kind of a phased in exclusion of gain for holding it 3 years or 4 years. You can still get a partial exclusion if it were to sell that quickly. And then you'll see they raise some of the gain exclusion up to 15 million. So, 50% increase there, and then raise the eligibility at the company level up to 75 million. We could do an hour PowerPoint just on QSBS alone. And we're not going to do that. Don't worry. But there's a lot in here because a lot of the requirements need to be determined at the company level, but this is actually an exclusion that's taken by the individual. So that creates a lot of complexity too, where the individual doesn't always know they're holding QSBS stock until they're kind of either made aware of it by the company or their advisors. So a lot of times it comes up in a liquidity event and like, oh, you guys looked at 1202, like you may have stock here that's tax free. I mean, it can be, as much of a home run in the tax code as you can have. So something to be aware of. And this is for stock issued after July 4th. So, this is timely, and you could have a situation where you're already holding QSBS.
Yes. I'd imagine that'd be quite the pleasant surprise to find out that you're not going to have to pay taxes on the sale that you thought you were going to.
Yeah, there's some restructuring and things you can do if you started off as a partnership or you start off as an S corporation. This is why that the really boring topic of what kind of entity should I be, what kind of business entity should I choose. It's not just a legal question or an accounting question. You got to think about what's your ultimate exit too in the company, and to be planning for that, because this could potentially save you millions upon millions of capital gains taxes.
Something that people might be a little less familiar with on the qualified production property, and maybe give us an update there.
Yeah, so we're going to talk about bonus depreciation, which I think is a concept everyone's familiar with, going up to 100%. I know that's been in the news a lot, and business owners are pretty familiar with those concepts. This is a brand new concept that came into play, and this gets back to President Trump's focus on America investment, bringing back manufacturing into the U.S. And incentivizing that. So you'll see that this is a brand new concept. It doesn't, it basically allows you to, let's say you build a manufacturing facility or a new plant, to immediately expense a large portion of that building. So you think about it, normally, if you build a manufacturing plant, most of that plant would be depreciated over 39 years, maybe the whole thing. This could allow for immediate expensing when that's placed in service. Last time I checked, it's not very cheap to build a new manufacturing plant. So you can imagine this could be a massive deduction for some companies that do kind of invest back in the U.S. or building a plant. As anything, there's a lot of details that remain unknown about this. There's a lot of requirements that have to be met. There's been some guidance coming out on it, but there's still a lot of questions. So the construction has to begin after January 19th of 25, and you'll see that date, January 19th, a lot. If you remember that date, that was actually Inauguration Day. So it's kind of interesting. Or January 20th was Inauguration Day. So that's where that date came into play. So if the construction began, late 2024 or January 1st, 25, you wouldn't be eligible for this. So it's got to begin after. It's got to be completed before January 1, 29 and put in service before 2031. It doesn't include areas of the facility like office, administrative buildings, sales buildings. So there's going to be some a study needed or some guidance needed on how to kind of determine what portion of the building qualifies under this. But again, if you're a manufacturer out there or you know, distribution company that has some significant capital investments you're doing, or you're building out a new plant or adding on, definitely reach out to us, because we have some folks in our firm that just do cost segregation studies and are diving into these rules and can help you navigate this to make sure you don't miss potentially a huge deduction there, because it will take some planning.
I'm sure there's some people out there very disappointed they started on January 18th.
Yeah, exactly. Well, I didn't even pay attention to where that date came into, and then when the bill passed, and then I kept seeing that date, it kind of came out that was tied around the inauguration. But it's going to make things a little interesting for us accountants on the tax side, because if you're looking at fixed assets here in 25 and new improvements, the date really matters. Was it January 1, or was it more like February 1, or was it like in the middle of January? So it's not just, unfortunately, it's not just the whole year. So that kind of leads into the bonus depreciation. Hit on this a little bit, but again, bonus depreciation was at 100% when the TCJA passed. It was then set to phase down to it phased down to 80 and then 60, and was set to phase into 40% here in 25. This retroactively changed that back to January 19th. Again, that date is important, where if you place property in service, acquire and place property in service after that date, it qualifies for this 100% expensing. So furniture, equipment, computer software, all these things that are kind of less than a 20-year useful life, you may be able to have immediate expensing there. The date matters, because if you had already started or entered into a contract in 24 and you were already going to purchase something, it's probably not going to qualify for this 100%, and you're going to fall into that 40% rule. So you may have a building that you started 2 years ago, or a building that doesn't go into service even until 2026, and you may still be looking back to 40% depreciation because you don't meet the requirements to get that 100% expensing. So a lot of planning needed here. We still have Section 179 expensing as well, which can be up to like 2.5 million, adjusted for inflation a little bit, but that's also another way to expense new capital improvements. So there's a lot to look at here with these new concepts, bonus depreciation. Again, if you're buying a lot of property or placing a lot of equipment in service, you probably want to talk to someone that's an expert in this area. Talk to one of our cost segregation experts, because there's a lot of ways we can help you out. These are really taxpayer favorable rules, but you gotta navigate it. And then real quick, interest expense, basically a favorable change there, where there's a limitation on the amount of interest you can deduct. That was going to, starting in 26, be based on EBIT instead of EBITDA, meaning you couldn't include depreciation and amortization in that. So now the base that you can use to determine how much interest you can expense is bigger. So that's a good thing. You can deduct more interest. So favorable there. And then research and experimentation costs. This was something that came into effect a couple of years ago, in 21, based on kind of a phase out similar to bonus depreciation, was never intended to become law. Fast forward, Congress doesn't do anything and it becomes law. And so we have these very unfavorable rules the last couple of years, where all of your research and experimentation costs had to be capitalized and amortized over 10 years for US, or 15 years for foreign. Very unfavorable, because you think about some of these costs were things you always had immediate expensing on. You're hiring developers, you're paying contractors to develop new software, research and development. We want to incentivize research and development as a country, obviously, from just a policy standpoint. This was just really bad policy. And it had a lot of bipartisan support, but was just never able to get fixed. One Big Beautiful Bill Act retroactively fixes this, and even allows for some immediate expensing in 25 of all these costs, or the ability to spread it out to 25 and 26. So I know we've kind of taken a detour here on the business stuff, but just wanted to highlight some of these major areas because, probably these three areas could equate to way more dollars than anything we're going to talk about on the individual side. So if you are a business owner or an investor in a pass-through entity, you want to look at how these things are going to apply because for example, we talked about, planning around your income and state and local deductions or charitable. If I'm going to have this huge deduction for research and experimentation costs occurring in 26, that's going to impact now my individual planning and charitable planning and the benefit I'm getting there or bonus depreciation. How does that impact my individual situation? So, all these things are kind of interrelated.
Yeah, that's great. As we transition back to the personal side, there is a big personal tax that could be just as large as some of the business tax expenses. So maybe Scott, if you can give us an update of some of the things that changed on the estate tax exemption, then we'll tap Michael to talk a little bit about how to plan for it and some strategies that you can use.
Absolutely. So that again, this is more about what didn't happen. The estate and gift exemption was set to sunset to 5 million per individual. So 10 million for a married filing couple, which would include a lot more taxpayers than it does now. It was permanently increased with an index for inflation to 15 million starting in 26. So good news there, to the extent husband and wife pass away and their total estate is less than 30 million, they're not going to be subject to estate taxes. So great news there, provides us with some semblance of permanency here that we can plan around. I know Michael's going to kind of dive into more, but yeah, the good news on the estate planning front. And Mark's right. I mean, this is an area where, you know, it's very rare that I can save someone millions in income taxes, but on the estate and gift side, you really could be saving millions by making gifts or getting things out of your taxable estate for your future beneficiaries.
Sounds like a great reason to talk about strategies on how to do it.
Yeah, so like Scott said, the good news here is that this was a permanent extension of what was passed in 2017, and we've been having conversations with our clients about this potential change here for some time because clients with significant estates were facing a potentially massive increase to their estate tax liability, and so the passage of this law gives us a longer runway to work with families. And as you guys all know, look, estate planning is not just about the tax management. It's about ensuring that your goals and your values get passed down to the next generation or generations in the way that you would like. But this slide here does highlight one important aspect in that while having that lifetime gift exemption moves a substantial amount of wealth outside of your taxable estate, the timing in which you make these decisions can also move a substantial amount of growth outside of your taxable estate. So on this page, we have two examples. The scenario on the left, the family chooses to make their gifts today. And then the scenario on the right, the family chooses to make their gifts 20 years from now. And of course, Scott has said many times, every family, every individual, their situation is different, but we're going to keep the assumptions simple just for sake of the conversation. So on the left-hand side, we've got a family that their total estate is $40 million. The parents each use their $15 million exemption, creating two trusts. And then that means the remaining amount within their estate is $10 million. We grow that family wealth. Let's just assume that it grows for 20 years at 5%. And in 20 years, the family wealth is 106 million under that assumption. Now, of course, that 106 million is split into three different buckets, we'll say. But you apply that 40% estate tax liability, which is, quite penalizing. And their estate tax liability at that point is roughly $10.5 million. So the ending family wealth, when it's all said and done, is just north of 95 million. Now, for the family, if they chose to wait 20 years, they've got 40 million. It grows for 20 years at 5%. It's still 106 million 20 years from now, but they haven't used their exemption yet. Now, obviously, we would expect that the lifetime gift exemption also grows with inflation or some factor. So we assume that it grows with inflation. So instead of the parents being able to gift 30 million outside of the estate tax code, it has grown to roughly 50 million. So they create their two trusts, they fund those two trusts, and then the taxable estate in this scenario is 57 million. It's much higher than in scenario one. At that point, applying that same 40% tax rate, the estate taxes owed are nearly 23 million. So significantly higher just because they chose to wait. They did the same thing, they accomplished the same gifting, they had to write a bigger check to the government because all of that growth or a lot of that growth was captured in their estate. And the important thing here is not that it's necessarily wealth that you may or may not have wanted to pass down to the next generation, but it's wealth that you may have made different decisions with. You could have, if you're philanthropically inclined, you might have wanted to direct which organizations it goes to. You may have wanted it to go to your kids, or you may have chosen to spend more. So I think the point here is planning early, having these conversations sooner rather than later just allows us to craft and work through a more thoughtful estate plan.
Yeah, that's great. It shows that, yeah, not just save $1 million, we're saving 10 million here.
Yes.
And so to shift, this is obviously a great gift that you can give your family that they receive after you've passed. But maybe we'll focus now on something a little happier, gifts that you can give to make your family's life better while you're still with them.
Yeah, hopefully everyone's heard of kind of 529 plans. I mean, these are certainly really popular among our clients and a lot of individuals. There's a lot of different state versions of these in each state, but these really allow you to kind of not just plan for college, but also even can cover K through 12 private school expenses and education expenses. So just kind of wanted to highlight here, the one big beautiful bill, I kind of expanded this. It increased the limit from 10,000 to 20,000 of expenses that you can pull out each year, or distribution for, K through 12 expenses, curriculum, tutoring, online education. It's kind of been expanded more to like things like standardized test fees and ACT prep, and even like you'll see here, CPA credentialing. So, if you're studying for like a designation or professional designation. So a little bit more ways to um, enhance and expand these. So good benefits to dive into, because if you have these accounts, or you have amounts that you've accumulated and your child didn't use them all, there's some other options too around rollovers to IRAs, or using them for maybe a niece and nephew or grandchild. So definitely want to be aware of these.
That's great. Michael, so what are some good strategies for families with young children using 529s?
Yeah, look, there aren't many tax shelters that are available to us, so 529 plans are one of them, and they're a great option for tax advantage growth as families save for their children's education. That's the bottom line. I think what's important here, just especially for families who, are asking themselves the question, well, what if my kid doesn't go to college? Or maybe, what if I save too much and I have all this money tied up? I think what's important here, and Scott touched on, is that the rules around what's considered an allowable expense continue to expand. And Scott mentioned this, but just a couple of years ago, the legislation opened the door for under certain stipulations for certain amounts within 529s to be able to be converted to Roth IRAs, which is a long-term tax-free retirement savings vehicle. And I think what's going to be really interesting, just as we move forward, is how are these rules going to evolve, right? People have a lot of money socked away in 529 plans. They're a phenomenal savings vehicle for college. But I think we could certainly, I don't think it would be unrealistic to think there's, these rules start to open up a little bit to give people the flexibility that they want or need.
That's great. And the OBBA opened up a whole new type of account that I think we're pretty excited about. I know Michael's very excited
I am.
about the new Trump accounts.
So, yeah, speaking of tax shelters, this tax bill created a new one for individuals under the age of 18. And, I'll preface this by saying there's additional guidance to come. So there's going to be, some rules and regulations that are going to come out over the next year that we just aren't aware of yet. But as it stands today, parents can open Trump accounts for their children that are under the age of 18. You have to wait until I think June or July of next year before you can officially open them. But the interesting thing here for children who were born between 2025 and 2028, the government will seed those accounts with $1,000. And, of course, why are these valuable other than them being a tax shelter? It's that contributions can be made to those accounts of up to $5,000 per year until the child turns 18. When the child turns 18, it flips to an IRA and is just subject to the rules that we all know well for individual retirement accounts. This is really valuable for families that are interested in establishing long-term tax-deferred savings for their kids. 529s have really been the key option until recently. I mean, certainly IRAs have also been an option, but the difficulty with IRAs when your kid is 5 years old is that they have to have earned income. And so
Yeah.
sometimes people get creative, but that's a hurdle that families kind of struggle with, and Trump accounts do not have the earned income component. So what's really valuable is here it's an opportunity for families to establish long-term tax-deferred retirement savings vehicles for their kids. And I'll just emphasize this point, Mark, if you can go to the next page. This graph here is just a hypothetical scenario of mom and dad contributing $5,000 per year for 18 years to one of these accounts for their kids, and the account growing at 8% per year. So they stick it into, some, market equity ETF, and it grows at 8% per year for 60 years. And, at age 60, your kid has $4.7 million of retirement savings without really having had to, do anything on their own. Obviously, this doesn't account for market volatility and real market conditions, but the point here is compound interest over a 60-year period is incredibly valuable. So this is something we're excited about from a planning standpoint, and there's more to come, but I think this is going to be a really valuable tool that we can start to implement for families interested in helping their kids establish a savings.
Yeah, it's really an amazing new tool.
Yeah, especially when you think about if you're just gifting to your child, and putting it in taxable accounts or UTMA accounts. I mean, now you're dealing with kiddie tax and them filing their own returns, even though they're minors. And then I've seen this. I mean, they'll have some kind of identity theft issue with their tax return, and you're opening up a lot more complexity, whereas these basically look like IRAs. And yeah, I know there's a lot more to come on them, and there's some restrictions what types of investments I think they can hold. But overall, I mean, you could literally make your kids trust fund kids here if you want, by putting in small amounts when they're young.
That's great. And so, Michael, what about on the portfolio management side? Is there anything here that's going to change how we're thinking about things?
Yeah, and like Scott has sprinkled in throughout, a lot of this law was an extension of what we got in 2017. So in terms of how we're managing portfolios, we aren't making major shifts in response to this new legislation. But with any change, it's always a good opportunity to revisit your strategy. So questions to think about, or questions that we're always happy to help you think about, or in terms of the way that we manage portfolios. Think about what kind of income is being produced in your portfolio. Is it efficient on an after-tax basis? Do you own municipal bonds, which are federally tax-free, or do you own taxable bonds? Are your capital gains, when you sell a position at a profit, are you realizing short-term capital gains, which are taxed at ordinary income rates, or are they long-term capital gains, which are taxed at more advantageous rates? Um, is there an opportunity to tax loss harvest in your portfolio? So that means, just using kind of a loose example, maybe I bought Coca-Cola in my portfolio and the market happened to fall, such as it is down today. So I sell Coca-Cola, I harvest a loss for tax purposes, but I reinvest in Pepsi to make sure that I maintain my market exposure. Um, to that end, how much turnover is in your portfolio? And what I would say there is, when it comes to turnover is not necessarily a bad thing, but it's also not necessarily tax efficient. So making sure that your team, when they make changes to your portfolio, they're doing it thoughtfully and they're considering the tax implications of the changes that they're making or that they're recommending. And then the last bullet point there just gets into, which assets do you own in your IRAs and your tax shelters versus which assets do you hold in your taxable accounts?
And that's great. Thank you. And so as we're heading into year end, I think everyone's getting their Thanksgiving plans ready. What are some of the things we should start thinking about as we get ready to ring in the new year?
Yeah, so just a few good year-end reminders. One of those, of course, being what we talked about early on around charitable giving, right? If you are thinking about big gifts, or if you're planning on big gifts, 2025 is a great year to do it before the law changes in 2026. For those of you who are at required minimum distribution age, let's make sure that those get taken before year end. Um, Evaluate Roth IRA conversion opportunities. It's a great chance to work with your advisor as well as your CPA around, what's my marginal tax bracket? Can I convert up to a certain amount? And then potentially convert more in January once you're in a new tax year. Evaluate your qualified retirement plan, your IRA, your Roth IRA, your HSA contributions. Review your college funding and any 529 contributions you want to make before year end. Any other gifting that you've been thinking about before the end of the year. And I think, the last few bullet points, any appropriate updates to your estate plan. Again, the good news is we are not in a mad dash heading into 2026, which, a lot of people anticipated heading into the back half of this year. So we have time there, but it's good to continue the conversation. Assess the portfolio for tax loss harvesting opportunities. I can tell you, we regularly do that here. We love tax loss harvesting. So where we can create a meaningful, tax benefit, we like to do so. We can't emphasize enough. I wouldn't even necessarily say this is a year-end reminder. This is maybe a everyday reminder. Review your cybersecurity protections. The world's getting more complicated and sophisticated every day. And so just make sure that, dual factor authentication, passcodes with your family members, etc. Just make sure you feel very comfortable with how secure that your wealth and your other kind of, important items are. And then I think lastly, evaluate your liquidity needs for the next year. And look, there's no better time to evaluate your liquidity needs when we're coming off of our third straight year of phenomenal equity market returns. This is a great time to consider rebalancing, to replenish your cash reserves if you're living off of your portfolio, right? The last thing that we want to do is be selling equities right after a market sell-off. We like to sell equities, raise cash from our equities when the market's doing well, and we can, take our chips off the table.
Great. Thank you, Michael. And with that, we want to thank everyone. I think we've gone over time a little bit, but if anyone has any questions, of course, feel free to reach out to your advisors or any contact you might have at Gryphon or GBQ. We definitely want to thank Michael and Scott for walking us through. We appreciate everyone that's here and attended, and let's just help you every day, trying to help accomplish our mission of making people's lives better. Thank you.
Thanks, Mark. Thanks, Scott.
Thank you, everyone. Thanks for joining us.